And that's the part nobody talks about. Not everything went to zero. Some things did. Most things did. But some assets, a handful of them, came out the other side. Not because their owners were lucky, not because they saw it coming, but because of what those assets actually were. At the moment the rules changed, there were 5 types. They didn't survive the same way. And the order in which they survived tells you something that no financial news channel is going to explain to you. Because explaining it clearly means admitting how the system actually works. So let's go through them. Asset 1. Physical cash, in the right place. When things started unwinding, most people did exactly what you'd expect. They tried to get their money out. They believed cash was the safest thing. Liquid, simple, yours. What they found instead was that access to cash and ownership of cash are 2 different things. Branches closed early, ATM limits dropped to amounts that wouldn't cover a week of groceries. Wire transfers got delayed without explanation. Some were told to come back tomorrow. Tomorrow became a word that meant something different now. The people who had already moved physical cash somewhere accessible, not a lot, just enough, didn't have to ask for permission to use their own money. They just used it. Everyone else waited. The line at the bank is a quiet thing until it isn't. Asset 2. Land with no debt attached. Land has always meant something. Security, legacy, something you can stand on. People who owned land felt protected, and in most cases, they were right eventually. But there was a gap, a period where eventually felt very far away. What happened in that gap is the part worth understanding. Property values didn't disappear, but selling anything became nearly impossible. No transactions, no buyers with financing, no functioning process for transfer. So the value was real, in theory. In practice, it was locked inside the asset with no door. The people who held land with a mortgage attached found something else. When credit froze and banks started restructuring, some loans were called or modified in ways that weren't voluntary, or transferred to new servicers with different terms. The land stayed, the debt stayed, but the original agreement, the one they thought they signed, was now being interpreted by someone they'd never met. The people who owned land outright had something different. Not access to cash, not liquidity, but a position that no one could reclassify. It was theirs in a way that didn't require anyone else to agree. That distinction between I own this and I own this, pending the arrangement I made to acquire it, turned out to matter enormously. But that wasn't the worst part. Asset 3. Foreign currency held directly. Some people had been cautious, not paranoid, just cautious. They'd held savings in another country's currency, a hedge, a backup. For a while, that looked smart. Then came the controls. Governments under pressure do predictable things. One of them is drawing a line around the money inside their borders and making it very difficult for that money to leave. Conversions got restricted. Rates got officially set at numbers that had no relationship to what anyone would actually pay. Foreign accounts held inside the country got caught in the same net as everything else. The people who held foreign currency outside the country in accounts they controlled, in jurisdictions that weren't affected, held something real. It converted. It moved. It bought things. The people who held foreign currency inside the country through a local bank, or through a product that said it tracked a foreign currency but didn't actually hold it. They discovered what tracking means when the system tracking it stops working. It means nothing. The number existed. The underlying thing did not. This is where it started getting uncomfortable, because these weren't obscure instruments. These were products that banks sold to ordinary people specifically as protection. The pitch was safety. The structure was exposure. Most people had no idea there was a difference. Asset 4, precious metals held physically. Here's where the pattern becomes harder to look at directly. Gold and silver have survived collapses throughout history. That part is true. But survival meant something specific. It meant surviving after. The during was different. During, there were confiscations, restrictions, rules passed quickly that said private holdings needed to be declared, surrendered, or exchanged at rates the government set, not the market. This didn't happen everywhere. It didn't happen every time. But it happened enough times, in enough places, that it belongs in the honest version of this story. The people who navigated that period, who held physical metals and came out with them intact, generally shared one trait. Their holdings weren't visible to the system that was doing the restricting, not hidden in a criminal sense. just outside the reach of the mechanism being used. The people whose holdings were registered, declared, stored through an institution, or documented in a way that made them findable. Some of them found they were holding something that the government had. For now, that word temporary has done a lot of work in financial history. The metals themselves held value. That part was real. But value and access to value are not the same thing, and access, it turned out, was conditional. Most people never saw this coming. Asset 5 claims that we're actually equity in disguise. This is the one that takes a moment to understand. Stay with it. Some people held what they were told were safe: senior claims, bonds, preference shares, structured products from major institutions. Things that sat supposedly at the top of the pile. Things that, in any normal loss scenario, would be paid first and paid in full. They believed they were protected. The documentation said so. The salesperson said so. The rating said so. What they discovered is that the rules about who gets paid first can be rewritten, not secretly, publicly, through emergency legislation or regulatory decisions made over a weekend. What was senior became less senior. What was a guaranteed claim became contingent. What was supposed to be paid before shareholders sometimes wasn't. The people who survived this weren't smarter. They weren't more suspicious. They held something different. Actual ownership, direct, simple, hard to reclassify. When you own something directly, land, a tool, an operating business, a physical thing, there's no document that a regulator can amend that changes what you own. You either have it or you don't. When you own a claim, a promise that something will be paid, a contract that guarantees a return, a document that says you are owed, the thing you actually own is the integrity of the system honoring that promise. And when the system is under enough pressure, promises get reordered, not randomly, by hierarchy. The hierarchy just wasn't the one people were told about. What actually determined survival? Here's the pattern. Once you can see it, it wasn't asset class. It wasn't country. It wasn't even wealth level. Because there were wealthy people in every one of those categories who got caught, and ordinary people in some of them who didn't. What determined survival was the distance between the asset and the system that was failing. Cash in a functioning account, still inside the system. Land with debt, still inside the system. Foreign currency tracked by a domestic institution, still inside the system. Metals held through a registered custodian, still inside the system. Senior claims issued by institutions that were being restructured, fully inside the system. Every asset that survived intact had one thing in common. When the system pulled back, the asset didn't go with it. Not because the owners were clever, because the nature of the ownership was different, direct, unmediated, not contingent on any institution continuing to honor an arrangement. The losses weren't chaos. The restructuring wasn't random. There was a sequence, a real one, and the people at the bottom of it found out their position at the moment. It was too late to change it. The hierarchy existed before the crisis. The crisis just made it visible. That's the thing about these periods. They don't create new rules. They reveal the rules that were always there, operating quietly in the background while everything was stable. The assets that survived weren't special. They were just structured in a way that put their owners outside the sequence. And that structure, the distance between what you own and what you're owed, still exists today. It's still operating quietly. In the background, while everything is stable,